Hi, everybody. You're all coming in. Editing myself this week. There you are. Say hi. Yeah. Say hi. Hi. Yeah, but that's you. You say hi. Say
So
hi.
cute.
Say hi. Yeah. Okay, we're waiting one more people in. Yeah. We're letting everybody in the class. See? Yeah, we're letting everybody in the class. Pierce, do you need food? Pierce, do you need to eat? No? Let's wait a few minutes here. Steven, I saw that you just signed up for Bloomberg. I did just approve it. If any of you just joined, we're just waiting about 2 more minutes or so for everyone to log in. Again, we're just waiting here for about another minute or so. Okay, I'll just admit people as they come. Okay, so let's see. Can everyone hear me? Yes, yes. Someone say, I hear you, or at least something. I'm assuming yes.
We can hear
If
you
not,
fine.
okay, perfect, excellent. Okay. Oh, great, thanks, Steve. Yeah. So anyone, really the biggest update I would have for anyone would be the Bloomberg thing ended up taking a little bit longer. It looks like we're on the last step. You should still go through that initial process. So even like Steven today, Jerry, I saw you did it, I think a day or two ago. You can still go through the process of like creating your BMC login. You're not going to be able to start the class stuff until this last step is completed. The last step for any of you who really care is they have to actually physically install 2 more licenses in the lab. So someone did that today, but they didn't fully do it today. So I think they're going to finish it tomorrow, I'm hoping. Once it's done, though, don't worry. I'll tell everyone, and then you can kind of get to work on, you'll be able to start working on Bloomberg market concepts. You can play around. The nice thing about waiting this a little bit longer is we'll actually have 11 consecutive licenses that can be used, meaning that up to 11 of you at any one time can be logged in and using the terminals. So that'll be nice access for everyone. Again, it's taken about a week or 2 longer than I thought it would, but it's only me doing it. So, but we should have this figured out here pretty soon. I guess the only other thing would be, again, you should all be aware that there are the kind of the multiple choice assignment parts to the chapters that we're talking about. I know basically the only change of what I've been doing here is I have actually been still talking about the chapters, even though I did post things from 2 years ago when I made the lecture. I just think there's something to be said for the fact of doing it even another time where you're actually getting to see the slides more clearly. I don't know, I think there's just something to be said for that. But if you really feel like totally I'm wasting time, you should totally save space. It's your time to say it. You can email me and just say, Shading, there's no need to do what you're doing. But again, just like always, every lecture is being recorded and you can watch it. But there's still a purpose to being here now. I don't know what is going on with my son here, but he's pretty upset about something. There's still a purpose to you being here now because I'll know who's been here and know who's participating actively in the class. I hope there's, why don't you just stay here? You want to say hi? Say hi. Okay. Okay, so let me get into the lecture and get into kind of what I've been thinking about this week. Okay, so I'm going to share my screen with everybody here. Let's see. Can everyone hear me still? Yes or no?
Yes.
Was it device? Okay, perfect.
Yes.
Okay, perfect. Great. Okay, I'm sharing my screen and hopefully you can see what I'm doing here now. If you can't see pictures, at least say something if you can't see pictures, otherwise I'll assume you can. Okay, so what I want to talk about, again, when I'm doing this kind of initial discussion here, this is not part of an exam, it's not part of really anything you could be totally zoning out right now if you want to be, because really what I'm trying to do is just say, can I give you a vision to what, like me as an economist, what am I thinking about like today? Like what am I thinking about this past week, knowing what I all know as an economist? And the one, sorry, there was actually a really good, where would it be? Sorry, I'm just looking at my email here. Open with. Okay, I'm not usually one prone to making us watch a video, but this is a pretty important video because what's been happening here the past month is really a fundamental shift in how central bank activities are occurring, meaning how the Federal Reserve is acting. And it's gone pretty much unnoticed because we've all obviously been talking a great deal about the pandemic. But it's a pretty monumental shift, and it's been ignored. And if anything, I'd like to try to highlight that for the next 20 minutes of discussion here. So I'm just going to start here by showing a short video by Greg Ip. Greg Ip is among journalists that cover the central bank. He's among the most respected, and at least well-known, or popular, I guess you would say. That's a pretty low bar if we're talking about popularity of central bank journalists, but he is the most popular. I don't think he's got like groupies or anything like that. I don't think he's that popular, but I don't know. So I'm going to start off by showing this video. I'm hoping, as I'm showing it to you, that you're going to hear the audio. If for some reason you can't hear the audio, please say something.
Introducing Schwab Stock Slices, an easy way to start investing. Own fractional shares of some of the top.
For the past year and a half, my colleagues and I on the FOMC have been conducting the first ever public review of our monetary policy framework.
The Fed has been struggling for a while to figure out exactly how it can get inflation to its target of 2% and keep it there. And so for the last year or two, it's been undergoing what it calls a framework review to try and reconsider exactly how it goes about pursuing the goals that Congress laid out for it, which are full employment and low stable inflation. Powell's speech and the accompanying new statement of principles lay out a couple of important innovations in how the Fed plans to go about adjusting interest rates and its monetary policy to try and get exactly the right mix of high employment and low inflation.
Our new statement indicates that we will seek to achieve inflation that averages 2% over time.
So probably the most important innovation in this statement.
So right there, I'm just going to pause this every now and then. Although Greg might just reiterate what I'm about to say here, but that's fine. You get to just hear it twice. Perhaps unnoticed, but still very important in what was just said, was Powell saying that they wanted an average of a 2% inflation rate. And that's pretty important because before, since 2014, well, actually going back to 2012, there was a firm, Pierce, sorry. Since 2012, there's been a pretty firm desire to have exactly 2% inflation. Now we're just saying an average of 2% inflation. And what that means is that the Federal Reserve is signaling that they're going to allow the inflation rate to temporarily be greater than 2% if needed.
The Fed says it still has an inflation target of 2%, but what it's going to be looking for is for inflation to average 2% over time. Why is that important? Well, it means that if you have a period like we have recently, where inflation is below 2%, then it means you need to run inflation above 2% for a while so that it averages 2%. Why would the Fed want this? Why would it want inflation to actually be higher than its target? Well, the reason why is that if inflation is persistently below 2%, people's expectations will eventually adjust downward. Inflation will stay below 2%. And over time, we know that low inflation also brings about very low interest rates. And that's a problem because if interest rates are really low in normal times, the Fed has less room to cut them in bad times, like right now. So they would very much like to find a way to get inflation to stay at 2% or a bit higher so that they don't lose that interest rate cutting room.
I'll revise.
So what he's adding on to what he's saying there, he's saying that if he, because again, for most quarters, most months, the inflation rate has been less than 2%. Everyone then adjusts their expectations downward so that everyone thinks the inflation rate will remain less than 2%. And up to now, or up to the end of last month, no one ever expected that the Federal Reserve would ever allow it to be greater than 2%. And again, what Greg was mentioning and what Chairman Powell was mentioning was that in actuality, we could have future quarters. We could expect future quarters for it to be allowed to be greater than 2%, so that it averages 2% over the long haul.
Statement emphasizes that maximum employment is a broad-based and inclusive goal.
The Fed is here implicitly saying that although we have a goal of full employment and stable inflation, and for now we think the full employment part is the one that really drives our thinking. And when they say full employment, what they mean is that this has enormous benefits for the entire country going beyond just the monetary policy implications. What we discovered in the months before the pandemic is that as unemployment fell to its lowest level in 50 years, the benefits became more broadly shared. You had a lot of demographics and groups of workers who were often left behind in our economy starting to benefit. People who had criminal records were being hired, people with disabilities, racial groups whose economic circumstances had often lagged behind. Whites started to catch up. And this year, with the reckoning over race, of course, that's even more important. So what the Fed is basically saying here is that there are a lot of really good things for society that can be achieved if we are successful at achieving full employment.
In addition,
so what we've got going on right there is just a discussion of the fact that for the most part, economists most of the time don't care that much about employment, and Chairman Powell there is just reiterating that it's actually pretty important to still talk about full employment.
a revised statement says that our policy decision will be informed by our assessments of the shortfalls of employment from its maximum level, rather than by deviations from its maximum level, as in our previous statement.
Central banks and economists have long assumed there's this trade-off between unemployment and inflation, that the lower unemployment goes, the tighter the labor market becomes, and that starts to eventually lead to higher inflation. And so because of this trade-off, you wouldn't want unemployment to go too low because it would lead to accelerating inflation, and that would eventually lead to dramatically higher interest rates and a recession. But nowadays, you don't really see that trade-off any longer. Unemployment seems to be able to go very low, and you just don't see that response to inflation. And so in this change in wording, the Fed is implicitly telling us that there really is no such thing as the unemployment rate ever going too low again.
A key purpose of our review has been to take stock of the lessons learned over this period and identify any further changes in our monetary policy framework that could enhance our ability to achieve our maximum employment price stability goals in the years ahead.
The Fed used to think the lowest unemployment rate you could have before inflation took off was around 5.5%. But it went below 5.5% and there was no inflation problem. So they said maybe it's 4%. But then we went below 4% and still no inflation problem. So those are the important lessons that they're trying to incorporate into this new assessment of how it plans to go about doing money.
Okay, so basically what you're seeing here, if we compare this to 2 weeks ago when I was talking about the major economic numbers and what economists generally expect, you saw that, I'm just going back to the regular screen. Okay. So what you can see here is that one of the rethinking points are, again, that instead of a hard line at 2% of inflation, we're saying an approximate 2% of inflation. We're saying instead of an unemployment rate being 5%, we're saying it could possibly be lower than 5% and still not cause inflation. And you're still pushing for maximum GDP growth. And you then might, in turn, allow it to be greater than 2 to 3% economic growth if you've got a great deal of employment. Now, I guess the question here then is, what was the news that came out this week that made me kind of think back to that article or that news that came out at the end of August? What we're seeing here is that on Wednesday, so just yesterday, Chairman Powell basically made in his economic report said that he thinks that the way that the economy has been affected since February with the pandemic is actually deeper than certainly what the market is showing. That the unemployment is longer, and that the yes, Pierce, what is it? Pierce, what is it? I'm right here. I'm behind you. Hey. Okay. That the unemployment rate is longer and more persistent, and that the interest rates, and this was the key point for the markets, was that the interest rates were expected to be near zero until 2023. Now that's pretty significant, because and that's a departure. So think back to what happened in 2015. In 2015, the interest rate had been near zero since 2008. So for about 7 years, the interest rate had been zero. And then once there was an expectation that the unemployment rate was going to be about 5%, and once there was an expectation that the inflation rate would start to go higher, that was when in 2015 they started to raise interest rates because they felt that unemployment was becoming already at 5% too low, and that inflation was too low. And so they started to raise interest rates. And so now maybe one of the thoughts is maybe we don't have to be as active in shifting the interest rate. Do we need to really raise the interest rate to alter inflation that actively? Or instead, can we look for this kind of average of 2%? Going back to sharing my screen here. Yes, Pierce. What is it? Apologies to everybody, but at least for 8 more minutes, and child watching at the same time. For those of you who have children, you'll appreciate it. For those of you who are single and mingle, you'll just think it's a pain in the ass. Okay, so let's look at this here. This gives you a pretty good idea here of what's going on in the economy and what I'm kind of thinking of here. So, let me see here if it'll let me draw. It will. Never mind. Let's see if I did this successfully. Okay. So you can see here, the inflation target is set at 2%, and that was as 2012. So that was pretty important for markets because now markets for the first time had a pretty clear indication that the Federal Reserve was going to do whatever it had to do to make sure that the inflation rate was 2%. Now, the actual inflation rate is this dark blue line here, and you can see that since 2012, here's the 2%, we've been consistently below that 2% in terms of inflation. So I would argue, and I think that the markets have ignored this fact, which for those of you who are the investing kind of people in this class, here would be your investing idea. The markets have totally ignored the risk of inflation coming back, and it absolutely can. And I would argue that the markets have become complacent because we've had 8 years where no one has said that there's going to be inflation. So again, what the Federal Reserve is saying and what I'm even saying to you here is the markets for the past 8 years have kept expecting lower and lower inflation, lower than 2%. And the Federal Reserve is trying to say, wait a minute, we are actually going to allow inflation to go greater than 2% because we're saying now Instead, this is an average rather than a ceiling of 2%. In other words, you could have a whole bunch of time period in the future where it's greater than 2%, so the average is 2%. Because look at this, since 1994, with these gray regions being recessions, in every recession, the average inflation has been going down, which would mean in general, what would markets expect now that we're in a recession now? It'd be that we're going to be lower. But what I'm saying to you, and what the Federal Reserve is trying to signal to the markets, is that the Federal Reserve may act to actually not make it fall, but instead rise. And if it does that, people would need to alter their investment behavior in order to get out of that situation, or to be able to react to that kind of situation. Here's the other thing that was released yesterday on Wednesday. I got this from the Federal Reserve website, so if you're ever wondering where I got something, the first picture came from the Wall Street Journal. This one's coming from the federalreserve.gov website. What you'll notice here is that the Federal Reserve, when the Federal Reserve meets, it releases the economists give expectations of what they think the inflation rate is going to be, and what the GDP levels are going to be, and what the unemployment rates are going to be. And you're seeing that here. Sorry, I'm just dealing with my same time here. And what you're seeing here, which again got all the news, what got all the news was the fact that the federal funds rate, which would be the interest rate, was expected to be near zero until 2023. So that obviously really affects the market. And if you look at how the market did today, and you want to understand why certain segments were affected so greatly, that's exactly why, because we're in a low interest rate environment, which makes it in general, it's a little bit more difficult for businesses to make money when the interest rate environment is so low. Then I want you to look at core inflation. Look at this. Markets are still below 2%, but they're slowly ratcheting it up closer to 2%. And the argument would be is that if this had 2024, 2025, that this might even be greater than 2%. That there'll be continued work on the unemployment rate, but that it will still, I think this is pretty optimistic, saying that it's going to go back to pre-pandemic levels by 2023. And you're seeing that here in 2020, not surprisingly, we're still going to have negative GDP growth for this year. You'll have some of the recovery next year, which would be above the long term, and then slowly ratcheting down further and further for a long-term rate of 1.9, for a long-term inflation rate, which will be on average about 2%. I don't know how on earth we would ever be anywhere near a federal fund rate of 2.5%. we've been nowhere. That's the stated policy goal, but we haven't been at that high of an interest rate since 2006. So I don't think it's happening anytime soon. Okay. Let me go back to this. Okay. Just looking at my notes here very quickly here. Make sure I've covered everything. No, that's it. So I know it seems a little bit odd that I would focus on that. And some of you are probably totally tuning out, like, why is Sheldon spending half an hour talking about Federal Reserve policy and why it's changing? But again, it's kind of the point of, if you're taking a course called Intermediate Macroeconomics, it would seem to me it's pretty important to talk about what it is that macroeconomists are most concerned about. And again, the thing that macroeconomists are most concerned about is this, again, shift that over the past 8 years, we've been committed to 2% inflation. Now we think it's going to be allowed to be higher. I, as an investor, personally would expect it to be higher than 2%. Yet I think the rest of the market is expecting it to be still consistently lower than 2%. In the end, one of us is going to be right and one of us is going to be wrong. The only problem is that I'm betting as the Federal Reserve is betting, and I'm saying I don't think all of the aspects of the market that everyone has correctly anticipated that inflation could start to increase further. Okay, that's all I wanted to say about like news stuff that's not something you need to worry about for the course. Okay, Jerry's asking here, your thought on the Fed's announcement of interest rate, what it means for short-term and long-term. Yeah, so I think what it means for short-term and long-term, Jerry, Jerry's question is, what is the impact it's going to have on interest rates? You know, it's like I'm actually in this kind of interesting position too, where right now I'm in the process of getting a mortgage, my very first one ever. Right, and so what's interesting about that for me as an economist is I'm trying to make an expectation of the interest rate for the next 30 years, right? Like if I think that rates are abnormally low right now, then I would just lock it in, right, for 30 years. But I would also need to expect that the banks also think it's going to be low for the next 3 years. I need to think that they're mistaken as well. The other side of it would be I could just say, I think, I don't know what the interest rates are going to be. I'm totally confused. I don't want to lock in an artificially high rate and then have to do this process where I have to keep refinancing. So why don't I just allow my interest rate to adjust all the time? I'm actually not exactly sure what I'm going to do yet. The interest rate I got quoted on a jumbo mortgage was 3.5%, which is about the national average for a jumbo loan. My general expectation would be then, right? So the quick math of what one would do here as I'm thinking about it. Right, I was quoted 3.5% for 30 years. The only thing that's making me, and Jerry, just add to the chat if I'm not answering exactly what you're thinking, but I'm just trying to walk you through what I'm thinking specifically as an economist talking about the market here. Sorry, 1 second. Someone's at my door here. Oh, hey. Hey, man, how's it? Thanks. Citrus, wanna? Yep. Oh, sorry, the UPS guy's coming at the same time. Yep. Take that. Oops. Give that to Papa. Give that to Papa. So this is what I was quoted. I made an application at Navy Federal for a mortgage. So for a jumbo mortgage, I got quoted 3.5%, 30 years. The only thing that's making me somewhat think I'm going to take it would be if I can get inflation to average even 2.5% for a few years, so that it averages out the other side, right, where it's been less than 2%. That would mean that in net terms, that the real interest rate in that case would be 1%, or even less than 1%, right? To the extent it's greater than 2.5%. That is, in essence, free money, right? I mean, either Navy Federal's got a lot of money on its balance sheet and it just would rather lend it out at less than a real rate of 1%, or it's or here's the other side of it. Do I make a bet? Do I make a bet that they think, is it the case that Navy Federal thinks that the inflation rate will be less than 2%, right? Are they thinking that inflation will be 1.5%, so that the real rate is 2%, right? Let's just say that this is a scenario that Navy Federal thinks. Let's say this is what I think. I don't know, right? Guess we'll find out 30 years from now who was right. I'm kind of siding towards this based on what I know about what the Federal Reserve, how it's acting, what its announcement was at the end of August. I'm sure Navy Federal also knows that Jerry Powell made that announcement and that they aren't totally confused, but maybe they don't think that the Federal Reserve is going to be honest about it, and maybe they're going to try to, that they're not going to follow their word. I don't know. I guess we'll see who's right or wrong on this. Jerry, does that answer your question?
Yeah, for the most part. Yeah.
Okay. Let me go to the slides then. And again, for everyone, it's probably easiest, even though there's background noise on my side, you should always feel free to unmute yourself and just ask a question, interrupt me as I'm going through the slides. If something seems confusing. Otherwise, I'm going to talk about the slides here for about 40 minutes or so, and then we'll take a break, and then we'll try to finish it up. And again, I'll post a recording afterwards, and let's go from there. Okay, so today's discussion is really about leading up to talking about monetary policy, which is what I've been all talking about now at this point. And so to talk about that, we need to talk about the monetary system. Not to, in some sense, to remind everyone about what money is. Money is whatever you want it to be. It really, truly is. It's anything that we can use to make transactions, to do transactions. Hopefully no one's just hearing about this for the first time here. But that right there is just paper, right? Nothing more valuable than that. The only thing that it's got, in addition to being paper, that gives it any value, is that the government says it has value. Right? This would be the clause. If you look on your money, for those of us who still actually carry money. that statement. This note is legal tender for all debts, public and private. Without that statement, we have no government assurance, no government statement that I can use that to pay off all debts, public and private. This is sometimes taken to an extreme, right? This would be like the crazy person that you see from time to time that like pays their like parking ticket with all pennies, right? I mean, technically speaking, you know, no retailer can say you can't use cash, right? I mean, retailers have some ability to accept forms of payment as they want, but in the end, pretty much everyone has a right to be able to use cash. Because if we were to start to say you can't use cash, right? Or if I was to say I only take Canadian dollars, or I only take euros as my currency of choice, or Bitcoin as my currency to do the transaction. I mean, technically speaking, there could be a problem with that because, right, you're undermining then the ability of the U.S. dollar, right here, to be able to be used to satisfy a debt. I'm not saying the government's going to get involved and stop you from doing what you're trying to do as a private business owner, but especially if you're the government, you can't stop someone from using pennies to pay for their fine, as annoying as it is. You can't stop it. There are other things that money does, though, beyond, like, is it just useful for transactions? Yes, I mean, that is its biggest thing. It's what we use to buy stuff, essentially. It's the medium of exchange. If we didn't have this, if we didn't have money, then we would have to barter. And that would get pretty creepy pretty quick, right? Right? Jerry might say, the only thing I know how to do is detail cars, right? The problem would be, right, I drive a shitty car, so I don't really care that much about my car getting detailed. And the only thing I can give to him is my economics lecture, right? There's nothing else I know how to do. I can make a really good hard-boiled egg sandwich. So unless he wants that or an economics lecture, the problem would be in our barter economy here, there's going to be no transaction between Jerry and myself unless I want my car detailed and unless he wants a hard-boiled egg sandwich. So, right, the economy, a barter economy, is almost always significantly smaller. What really encourages economic growth is when you have money, because now I don't care what Jerry's habits are. I don't care that he knows how to detail cars. All I care is that, his tuition is paid and I get my money from the university, right, from the state. That's all I have to care about. That's why money makes the market economy so much bigger. Okay, now, building on that, what's used as money requires there to be some store of value. Meaning it has to store its value to some extent over time. If it doesn't store value over time, then you would not be using it for investment purposes. Right, for instance, you see some people, when they make their investments, they only make investments in gold. Well, that would be because they don't trust that the dollar is going to be able to retain its value over time. What would cause something to lose its value over time? That would be inflation. Right? So people who buy Bitcoin, people who buy gold, think that inflation is going to be, let's say, greater than 50% a year. I don't know, I'm just making that number up. But generally, people that buy gold and Bitcoin are expecting some very high number. And because they're expecting this very high number, then if they don't want to lose half the value of their money by just sitting there, So they're going to use gold and Bitcoin, which is going to be able to preserve its value, or possibly even gain value. That'd even be better. But if we look at currencies around the world that are not relied on, like the Zimbabwean dollar, for instance, like the Jamaican dollar, then those things tend to lose, they tend to not be used as the primary currency anymore. Oh, this gives me a chance to show my favorite YouTube video, which many of you have already seen, but this gives me a chance to show my favorite YouTube video.
Professor?
Yes. Oh, yeah, sorry. Yeah, you can't see it, right?
Yes.
So thank you for saying something right away. Thank you. Stopped me from wasting everyone's time here. Okay. This gives me a chance to show my favorite video.
Low and stable inflation is to the economy what the baseline is to reggae music.
So that's the central bank trying to be cool, I guess you could say. Here's another one.
Inflation's not the enemy if we control it. If it's too high, the people are gonna cry.
And if it's too low, the country now go. When inflation is low, stable, predictable. Consumers and investors feel secure. And when we find a middle ground, the economy will grow some more. Can't loan school fee can start out. Granny saving now get not out.
And the BOG inflation targeting strategy that.
Low, stable, predictable. Yeah.
So why is Jamaica, the central bank in Jamaica, spending so much time talking about inflation in that kind of way? The reason why it's becoming so important for them to talk about it is because the use of the Jamaican dollar depends on people trusting that it's going to have some value over time, meaning that it's going to have the store value. Okay, so I'm back to the slides here. If you can't see the slides, say something. And then money is a unit of account. So money does these three things, primarily speaking. And anything that fulfills these three conditions is money. So is it the thing that we use to buy other stuff, that the thing that's being used as money holds its value over time, and is it the thing that we use when I say I'm going to pay you 50,000, we would say US dollars, right, or euros or Jamaican dollars. Right, in our case, all as a unit of account, all of our loans, salaries, rent, mortgage, all of these legal transactions, we all measure them. If you're in the United States, you measure them in dollars. So the US dollar is the money because it fills these three conditions. That's the only thing that gives the US dollar value in the United States. Meaning, it's entirely possible, although I don't think probable. I think it's at least possible. I shouldn't say I think. It is absolutely possible that Bitcoin could become the currency, I don't know, 20 years from now, let's say, or 50 years from now. It's absolutely the case that it's possible, but it's not probable. Because for Bitcoin to displace the US dollar, it would have to change all three of these things. And I think that, it just requires a generational change, right? It's not like I'm old-fashioned, but I don't think I would ever want to accept the salary in Bitcoin, right? Because I look at the volatility of it, and I say to myself, it's not really storing value over time in a stable fashion. I don't want my currency to be gaining 20% in 1 year and then losing 20% in another year, and someone saying to me, well, on average, it stayed stable. That's not really the case, right? Because regardless, I'm always buying diapers. Diapers are a huge expense for me, right? So in 1 year, I'm paying 20% more for it in terms of my Bitcoin's purchasing power. And then the next year, I'm paying 20% less in terms of my purchasing power. That's not, how can I make any plans? And then when we talk about like a mortgage, a 30-year transaction that I'm going to be engaged in, by that point, I will be 73 years old. I'll be an old, almost dead dude. I'll be finishing off paying that mortgage. It's crazy to think about it that way, but I'm not going to be paying it in Bitcoin. It's going to require a change. It's a change that we've gone through before, right? Even in the United States, the idea of having a national currency as an invention isn't that, well, it's about 150 years old. Before that, individual states issued currencies. And if we look at it globally, we would obviously all know that the big change in monetary systems was the individual currencies in Europe all needing to adopt the euro in 2000, 2001, that kind of transitionary period. And so the Dutch guilder, one of the oldest currencies in the world, stopped existing in 2001, and it all became euros. And then this highlights the two types of money that exist. The only currency that we really have out there is fiat money. Fiat meaning the government, by fiat meaning like an edict or a law, the government says it is the money. Meaning, it's possible you could get, a president that says, you know what, I'm sick and tired of the dollar being used. I like the Canadian dollar. They usually have like a goose on it, or they got a leaf on it. I think it looks prettier. I'm just going to let's just use their currency. Nothing stops us from using another country's currency. So the government then would just say, you know what, dollar, US dollar, it can still exist, but you can use it if you want to. Yeah, but you don't really have to. But from now on, for instance, we're going to require that you pay your federal taxes in Canadian dollars. And we could require that you pay fines in Canadian dollars. They can even say things like you have to pay your employees in Canadian dollars. So the government can certainly push us to use something over another thing. But the debate then politically then becomes between those like myself who trust a fiat money and then others who push for commodity money. And I'm not trying to lump people together into like people being odd or crazy. I'm not trying to use the word crazy in a mean sense, but the idea that the US dollar is going to collapse, at least in our lifetimes, and I'm including your lifetime, not just my own. The idea that the US dollar is going to collapse, I think, is not probable. Because I don't think it's probable, I'm not putting all of my fiat money and turning it into gold as a transactional currency. I'm not saying that you hold it as an investment because you think that more people are also going to buy gold. I'm not trying to stop you from doing that, but up until 1934 or 1933, you could turn in your money always for gold. So, in fact, can everyone, if you can't see my browser, say something, please. So the US dollar used to look different. And the reason why the US dollar used to look different is because you'll notice here in very fine print, but it's just because I stole this picture here, it says this is a single dollar bill, but there's slight differences. It says here, pay to the bearer on demand $1. But it could also be converted to its equivalent value in gold. So the value of this $1 of currency in the year 1923 was that it could be turned into gold. So because it could be turned into gold, let's just see if we can find some better examples here. So you notice here as well, it's not, I'm not going to draw on this here, but you'll notice here at the bottom, $10 in gold coin payable to the bearer on demand. So what it meant is that when you held a $10 bill, and this is in the year 1928 or 1929, when you held this $10 bill, you were basically holding a piece of paper that was the equivalent of $10 worth of gold. It just meant that you didn't have to hold heavy gold in your pocket. You could just carry this bill and you could always turn it in for gold. And it even says here on the left-hand side, you can see it says gold certificate. What the problem with a commodity money is that you can only issue so much. So you can't, right? You can only make as much gold-based dollars as you have gold. So that becomes pretty limiting in what you can do. And it tends to limit your ability to grow the economy, which is why Franklin Roosevelt during the Great Depression ended the gold standard for US currency because he wanted to print a lot of cash and get the economy moving again by having the Federal Reserve do those things. By printing a lot of cash, expanding the money supply, which you can't do under a gold standard, which is why no currencies in the world follow the gold standard. None. Okay, I'm just going to skip this here. So when we think about what the money supply is then, it's controlled for by the central bank. The central bank has the job of controlling the money supply. And when we have too much money supply, I'm going to refer to money supply as M subscript S. When we have too much money supply, that's when we have inflation, right? Because if you have a lot of things out there, each thing is worth less, has less value, which is the whole definition of inflation. which is what Jamaica had for decades and decades and decades. Which is why now Jamaica, the Jamaican Central Bank is to say, you know what, dude, we are now going to, sorry, they wouldn't say dude, they would say man. You know what, man, it's it's our priority, right? Or in reggae, they would say it's the baseline that we are going to care a great deal about what the inflation rate is. So we are going to control the money supply. The question for investors is, do you believe them? Do you think that the Jamaican Central Bank is going to control the inflation rate? The markets are actually a little bit uncertain. And I'm spending a lot of time talking about inflation here because unless any of you are older than me, which I don't think is the case, I only from being a very little kid do I remember there being a substantial period of inflation. Not that I've always been an economist, but I must have always had some in the notion of being an economist because I can remember the severe recession of the early 80s. And I was like maybe 5 years old or 6 years old by that point. But my father, who was in the Army, bought his first house in 1979 with a VA loan and had a good credit score. His mortgage rate was 14% with his VA loan, 1979. Right, so a VA loan, meaning the loan was supposed to be good as anything, right? There was no credit risk involved here. And the best rate he could get with a good credit score was 14% in 1979. And that's because the inflation rate was so high. Why was the inflation rate so high? Because throughout the 1970s, the central bank, the Federal Reserve, had no credibility anymore. Throughout the 1960s and 1970s, well, especially the 1960s, the Federal Reserve had the worst Federal Reserve chairperson ever. His name was Arthur Burns. Horrible economist. Arthur Burns, some people say he was involved in Watergate because I don't know, I mean, the only thing to know about Watergate are watching that movie like All the President's Men, but in Watergate, there's supposed to be like these bribes or like the people that were breaking in had these like stacks of cash, but the cash was like consecutive numbered new $100 bills, and the only way that they could have gotten that was through the central bank. People say that's not why Arthur Burns is so bad though. For me as an economist, the reason why Arthur Burns is so bad for me as an economist is because in the 1960s, right? The U.S. was fighting a war in Vietnam. The U.S. was spending a lot of money fighting a war on poverty, right? This is the time when you get Medicare, Medicaid, food stamps, TANF, Head Start. You get all these pretty expensive, but I would argue also, to some, you can disagree with me, necessary social network, right? Of supporting at least some bare minimum of what people need to survive. Fighting a war in another country, fighting a war in poverty, and we're putting a person on the moon. 3 very expensive things that the federal government was trying to do in the 1960s. To carry all this out, to be able to pay, to manage U.S. debt at the time, they needed to print a lot of cash. And some people say that then Nixon and Johnson during this era pressured Arthur Burns to expand the money supply, which he did. And by expanding the money supply, he caused inflation. Which for the government made it easier to pay for these three expensive things. Because they could simply borrow the money, let's say in 1962, to buy a bomber to bomb somebody, right, in Vietnam. But they don't have to pay that loan until 1972, let's say it was a 10-year bond. But in 1972, if the inflation rate is high enough, it's not going to be totally easy to pay off that loan. Because people back in 1962 weren't expecting such high inflation. And if in 1965 I passed the Medicare program, I fund it by, again, borrowing money. But if in 1975 is when I pay it back, it's easier because I'm paying it back with less valuable money in 1975. Same with my Moon bond, which I borrow in, let's say, 1967, being paid back in 1977. But now think about this. 1973, 1975, 1977, the bankers are like, fuck, the government is totally screwing me over because they kept me, I had this impression that inflation was going to be 2%. If you can't see my screen, if you can't see my browser, tell me. Look at what happened here, right? And this is what I'm trying to emphasize here. That you have a period of time sorry, let me. I don't know how to do this, sorry. Trust me, what I'm doing is useful to some extent. Maybe. Probably not. Okay, never mind. I'm not going to get into the opinion. But you see this here, right? You see from 1960 to 1970, very steady inflation here. Nothing too dramatic, nothing too surprising. And the markets were expecting that because if we go further back, right, you had a 20-year time period, let's say from 1950 to 1970, where the inflation rate, even over this time period, went from 23 to 37. So 50% over a 20-year time period, that would be on average right about 2.5%. Just doing quick math in my head. But from 1970, let's say where it's about 37, to 1980, where it's 80, now you're seeing a doubling in 10 years. Meaning that you're seeing an inflation rate now that's north of 4% a year on average. On average. For a 10-year time period. That's a pretty significant increase, right? It's a near doubling, of the inflation rate over time. And again, you can get to these peak times. Where the only thing, if we look at what Arthur Burns did that was so bad, right, as a person who's controlling the federal funds rate, is despite the fact that the economy, despite the fact that the Federal Reserve was printing so much cash, it did nothing to try to control inflation. It actually kept the interest rates low to sort of still continue to grow the economy throughout the 1960s, despite printing all this cash. And what it did is it created a disaster for the economy then throughout the 1970s, where if you look at this, the interest rate then reaches a peak. Right, if anything, it looks like my father got a great deal, because in 1979 here, right, you've got interest rates here that, oh, I guess you got an okay deal, right? Interest rates here would be about 15% here on the federal funds rate. And good thing he got it then, because not even a year later, the interest rate was close to 20%. And a few years after that, when there was the pretty severe recession that I remember as a kid, the interest rate was greater than 22%, 23%. Why is he doing that? So this isn't Arthur Burns anymore. But at this point, we now, fortunately, in my opinion, and if you can't see, I'm now back on slides, so if you can't see the slides, say something. Actually, here's what we'll do here. How do you go from a situation where inflation is I'm just estimating here. But you have, in 1979, let's say, a scenario where the inflation rate's around 14% and the interest rate's around 14%. The economy that I was born into, I was born in 1977. The economy I was born into was a pretty shitty economy. Because I don't know why my parents even bought a house in 1979. Absolutely makes no sense, except they probably could blame me, I guess, right? Because babies take up a lot of, despite babies being small, they take up a lot of space because of all the junk that comes with them. they bought a house, despite the inflation rate being 14%, and then as a result, consequently, having to pay a pretty high nominal interest rate, right? Because if that's the case, right, for my father's mortgage, the real rate of interest from the VA, real rate of interest on that loan was 0%, right? Because basically all of the interest rate was taken up by inflation. Yet we reach a situation, let's say in 1982, now the interest rate, let's say, is approximately 25%. Now, this is what I'm going to ask you, the class, and someone should say something. What would you expect the inflation rate to be? Would you expect the inflation rate to be greater than 14%, or equal to 14%, or less than 14%? What would the inflation rate be 3 years later? If I, as the Federal Reserve, take action to raise the interest rate, what is that going to do to the inflation rate? Is it going to be higher than the 14% that it was in 79, equal to the 14%, or less than 14%? So anyone can interrupt, or someone should say something here. Not through chat though, because I'm not in Zoom right now. So just unmute yourself and say something.
Goes up.
Yep. So do we think the, yeah, exactly. Wait, I'm sorry. Did you say it goes up?
Yes.
No. So opposite, actually. Sorry. I thought you said goes up. Okay. So it's going to go down, but the reason why it goes down is because what are you, let's say if you're a business owner, what are you going to do and you're a business owner and the interest rate's 25%? You're going to be like, I'm not going to build up any more inventory because this is costing me a lot of money, right? And I'm going to cut my lines of credit. I'm going to not lend money to anyone anymore. I'm going to basically scale back. I'm going to scale back as much as possible because interest rates are too high. And us as consumers, right? No one's going to take out student loans. No one's going to buy houses. No one's going to buy a new car. Basically, The Economist in 1982, he just recently passed away, Paul Volcker, was perhaps the greatest central bank chairman we ever had. And what he did in the 1980s is he intentionally pushed the economy into a recession. And as politically difficult as that was for the president that he reported to, Jimmy Carter, right? And some would argue, right, if you're into politics, that right, that's what hurt Jimmy Carter, and you know that he couldn't get reelected because of what Paul Volcker did. But it was exactly what needed to be done, because when you are in this bad economy of 1979, the only thing you can do is intentionally destroy the economy, because what you're going to do is that by stopping as much economic activity as possible, by making the interest rate so high, people stop buying stuff, businesses stop producing stuff, and that lowers inflation, right? And really, in a few quick years, then you can basically lower the inflation rate, and then you can resume the economy then starting to have healthier employment. Oh, that's good. No, I screwed up your picture here, everyone, but you can look at it there. Okay. So there's our central bank here. This is the Federal Reserve building in DC. That is what our central bank is called, the Federal Reserve, or the Fed. And the primary way in which it controls the money supply is through open market operations. This is the buying and selling of existing U.S. debt, but also now, but the slides would not reflect is our altered economy today, and that would be an economy where today it's also buying, corporate bonds and other stranger things, but that's just because of the nature of the pandemic that we're in. But to highlight this a little bit further here, the central bank does not print cash. I'll repeat that again. The central bank does not print cash. Rather, what the central bank does is it changes the money supply by creating cash to buy something else. So it's not going to just be, so here's another way of saying it. It's not just going to print $1 million. Instead, what it's going to do is that the federal government is going to issue $1 million bond. And the Federal Reserve is going to buy that bond, but it's going to buy it with cash that never existed before. It's just going to like go into like the accounts virtually, the federal government's bank account, and it's just going to add $1 million to it. Right, so it's kind of virtually creating cash, but it's doing it by exchanging with it a bond. And the reason why that's important is because 20 years into the future, it can exchange that bond, make the government pay for it, and then destroy that money that it gets paid for it with. That's how the central bank gets involved in changing the money supply. Okay, it's now 6:22. I'm going to pause the recording for right now. Let's take a break here until, let's take a break here till 6:35 for the next 13 minutes. So I'm going to pause the recording. I'm going to place myself on mute and stop the video, and then we'll resume at 6:35, if that sounds okay with everyone. And I've started recording now. Okay, so let me go back to slides. If we don't get through all the slides today, I'm not going to rush through things. We'll just pick it up from there next week. But if we can, we'll try to. Are there any questions that anyone's kind of thought about over time? It can either be related exactly to the slides or macroeconomic history in the late 20th century, which is kind of what I've been talking about here in terms of inflation and interest rates. Any questions? Too bad you couldn't buy bonds. None of us were buying bonds in the late 70s. Think of the interest rate we would have gotten. Okay. Okay, if you can't see my slides, say something. So what we're saying here is then is the Federal Reserve controls the money supply. What does that money supply consist of? Well, one thing it most frequently consists of is currency, actual cash. So that would be, this is from 2015, so about 5 years ago. It's old data, but in some sense I'm a little too lazy to update this here. But in 2015, there's about $1.2 trillion in currency out there. Then where you really get the rest of this would be not from traveler's checks, but they are added separately. But really what you get it from are demand deposits, Demand deposits is another way to say checkable deposits. So your checking account is a demand deposit because you can demand your cash at any point. But your checking accounts, if we add in all the checking accounts and other near like cash assets like traveler's checks, that's where you get about $3 trillion. So currency is part of M1. Now M1, you add on to that then some things that are less liquid. When we say something is less liquid, we mean it can't turn into cash as quickly. So then if you add in M1 plus things that are less liquid, now you get close to $12 trillion in money supply that exists out there. So now that's as of 2015. Let's look at what it is here. Again, I'm just using the Federal Reserve Economic Database. Now look at that. And the reason why I did what I did is because the pandemic has obviously altered the situation. I mean, look at this, right? Let's zoom in even more here. Look at that. That we existed in a world where in January of this year, we were at a little over $15 trillion economy in terms of the money supply. $15 trillion. The money supply has now increased by a little under a third. Right, it's close to $19 trillion in the span of 5 months, 6 months. But the money supply has increased by almost a third in the past 5 or 6 months. Obviously, the Federal Reserve's reaction to the pandemic has increased the money supply as much as possible. And that's amazing. What you're seeing here is amazing. It's not something we're talking about because we keep, again, I'm not trying to say this heartlessly, but I'm saying, right, the news is only so long each day, right? Newspapers are only so long each day. There's only so many things we can talk about, even business-wise, each day. And so because of that, we're not focused as much on the fact that in the past 5 or 6 months, the money supply has increased by nearly a third. Now, what that does do right, sorry. It gives you a little bit, though, of a better understanding it gives you a little bit of a better understanding about I can't find what I've written here. But it gives you a bit of an understanding, right? This is, I was just looking for the slide where I was talking about walking you through it doesn't matter. Where I was walking, oh, I know where it is, sorry. No, I didn't say that. Never mind. Doesn't matter. This is where I was talking about the Navy Federal rate that I got, right? That would explain why maybe the real interest rate is close to zero because money is so cheap. There's so much out there. So imagine that, right? You've now got an economy that has almost a third more cash in it, which means that the cash is a third less valuable, right? Because there's now almost a third as much more out there. Which again gets me back to this idea of I don't understand why there's not more fear of higher inflation in the marketplace, because all the signs are there that there should be more inflation in the next 5, 10, 15 years. Okay, so let's start some equations here now to start to talk about this. So here's our money supply, M, right? Or as I've been referring it to as M subscript S. So what we're saying here is that it's going to equal the currency plus the demand deposits. Let's just call it, to make it a little bit more understandable here, let's just call it checking accounts. Currency in checking accounts is my money supply. Okay? Now, to understand how this money exists in the banking system that we have to think about the fact that banks, there are two kinds of banks out there. Incredibly rare would be the 100% reserve bank, right, where it keeps everything in reserves, meaning it keeps it all in like the vault. Most banks lend out most of their money. A bank on average lends out about 90% of its deposits, more if it's a bigger bank. So if a bank is lending out 90% of its deposits, right? So I'm borrowing from Navy Federal. Navy Federal is holding the loan actually for the life of the loan. Basically, right, I'm buying a house with the money from soldiers and sailors and space cadets, right? All of them put their paychecks into their Navy Federal checking account and savings account. And now I walk into the bank and I borrow the money, right? That's how banks work. Now, let's look at 3 different scenarios here, where I have $1,000 cash and I have these 3 different situations. No banks, 100% reserve banks, and a fractional reserve banking system. So if there's no banks at all, this one's pretty easy. $1,000 is printed. Basically, the money supply is equal to $1,000 as well, right? That's all that happens, basically. What you print is what you get in terms of increases in the money supply. So that's scenario 1, where there's no banks. Let's just call this what you print is what you get for changes on the money supply. Again, if you have any questions as I'm doing this, just unmute yourself and say something. I'm not in Zoom right now, so I can't see the chat. Now, let's look at it where the bank has to hold all of its deposits. So if the currency increases by $1,000, then, right, and that $1,000 is deposited here. Then it also, because it's 100% reserves, also be all held in assets. So what happens on the one side of the balance sheet happens on the other side of the balance sheet. With the net consequence is that there's, again, no change in the money supply. It's just that now I've got, it's kind of like scenario 1, where there were no banks. Basically now all I have is a safe place to hold my money. And then we have scenario 3. This lesson is important. I don't know if I would have covered up other parts of the slides here, but that's what was done here. So what if I create a banking system where there's a 20% reserve requirement? Then the $1,000 that was initially created is deposited. The bank has to keep 20% of that in reserves. That's right here. So that would be 20% of the 1,000. And then it lends out the remainder, the $800. Okay, so far, right, you've now got a, at least in this very first step, you still have the left side equaling the right side. But now that $800 that was lent out, when it's lent out, someone's going to spend that money, right? So I'm buying a house, right? I mean, that's the thing that's going on in my personal life here. I'm going to be buying a house, meaning that the Navy Federal has given me will give me at some point a big fat check with a bunch of balloons and say, here's your mortgage, right? And I'm going to take that check and I'm going to give it to the current homeowner, right, to buy their house. And that current homeowner is going to take that check and deposit it in their bank. So let's say that they bank at Second Bank. They're going to deposit my $800 mortgage check. So I'm basically living in a tent. And now that bank is going to also have to keep 20% of the 800. And it's now going to lend out the other 80%, 640. That 640 is going to go to someone else who's going to deposit it at their bank. And they're going to have, that bank will have to keep 20% of 640. And it will lend out the rest. This keeps happening and happening and happening until $1,000 that was initially printed becomes $5,000. We get that because the equation that we're going to work with here is 1 times 1 over the required reserve ratio, meaning 1,000 times 1 over 0.2 equals $5,000. So just having a central bank is not enough. It actually turns out that fractional reserve banking is so very important because without banks making loans, the Federal Reserve would have to do all of the work. Instead, you can see here that the central bank is only doing about 20% of the work, that the fractional reserve banking system is doing the remainder of the work. And that's what you see with this conclusion here, is it is creating actually a great deal of money through the lending out system. If banks stop lending money, the money supply is impacted. That's exactly what happened in the 2008-2009 crisis, was that banks were not willing to make loans. And so if banks are unwilling to make loans, the money supply does not change. But then also quite critically, the economy ceases to exist. Right? I mean, you can't say that about today. Right? You can, not that it's easy to get a mortgage, but not too difficult if you have an okay credit score. We could talk a little bit too about bank capital as existing here on this balance sheet. Banks also can hold its assets would be its reserves, its loans, but the bank can also own treasury bills, meaning you can own government, U.S. government debt. But whatever's on the left-hand side of the balance sheet has to equal what's on the right side. For those of you who are accountants, you'd appreciate what I'm saying there. Deposits are a liability. That's because someone can always come to the bank and say, I want my money that's in my checking account and I want to withdraw it. Then the bank is usually a business, so it has debt and it has owner's equity, and that's the other sides of this balance sheet. This isn't that important, so I'm just going to draw this here. You're not going to be responsible for that. Same here, just in the interest of time to focus on what's most important. One of the big changes that came about from the 2008-2009 crisis was that regulators gave a lot more attention to what the capital requirements were, meaning banks are more regularly put to what are called these stress tests, where they create a simulation of a deep recession, and they determine, does the bank have enough capital to be able to pay off all of its depositors, even if the Shidings of the world stop paying their mortgage? Will Navy Federal still be able to make things whole for depositors that take out their money on a normal basis? And what was found in 2008-2009 was that banks, because they weren't being subjected to these stress tests are only something that emerged after 2008-2009. Not Navy Federal, but other banks found that because of the recession and because people were not paying back their mortgages, then the depositors were not being able to get their money back. One of the more famous examples being the biggest bank that ever failed in the United States being Washington Mutual, which was also a big mortgage lender, was also a depositor that failed. Okay, so let's look at where we're at here. We've got the monetary base here, which is controlled by the central bank, consisting of currency here, and our demand deposits, which go into reserves. Then we've got our reserve to deposit ratio. That would be my reserves divided by my deposits. And then we've got our currency to deposit ratio. So whereas this is depending on the regulations of banks. So right, so this would be like my 20% rule, right? That I have to have at least 20% of my deposits in reserves. To what extent do people take their cash? Do people hold cash as opposed to putting in deposits? That's all based on preferences, right? I mean, my mother and father-in-law like to hold a lot of cash, right? I understand it, but that's what old people like to do. I've got the most money I've had in my wallet ever in a long time. I have $5 in my wallet. I suspect there are some of you who do not have anything in your wallet right now. This is actually not that. Let me try to do it quickly here. Not quickly in the sense that I want you to Just want to do this fast enough that it makes a little bit of sense. Okay, so here's my money supply. Currency plus deposits. If I wanted to restructure this, I could look at this with the monetary base, that the currency plus the deposits over the base times the base that the money multiplier that was like that number 5 that we saw, right? 1 over the required reserve ratio. If I take the money multiplier and I multiply it by the monetary base, that is the money supply, right? That was me saying 5 times the $1,000 base of the money supply gave me a total money supply, which was 5,000. That's what this top part is saying here. Money multiplier times the base of currency that was initially printed gives me my total money supply. I can then write that money multiplier to be my currency ratio plus 1 over my currency ratio plus my reserve ratio. Don't worry about this. You're on an exam, you're not going to be forced to write this all out. Just try to listen to what I'm saying and just somewhat see that hopefully it's making somewhat sense here. What's somewhat significant here is that the money multiplier can be impacted by, reduced by, the extent to which people decide to hold currency. And it's also reduced by, or affected by, not reduced by, but affected by the extent to which people hold reserves. Okay. There's an example here. Let's not, you can follow this, but again, if you followed, what's most important here is that you could follow what I did right here. As long as you can follow what I did up here, you're good to go. Now, what else can the Federal Reserve do to change the money supply? Well, again, the one thing that we talk about most often are open market operations. It can buy bonds from the federal government and it can sell bonds from the federal government. When it buys bonds, it creates the money to buy that bond. Thus, when the Federal Reserve buys bonds, it increases the money supply. When it sells bonds, it gives up its bond to someone who's buying it, and it destroys the money that it's given in exchange. So when the open market operation is a sell, that's an action of reducing the money supply. Increasing the money supply is known as expansionary monetary policy. Reducing the money supply is contractionary monetary policy. Expansionary monetary policy, you would use this during a recession, which is exactly what was happening in February, right? There was every expectation the pandemic was going to cause a recession, so they increased the money supply by a third. You don't see contractionary monetary policy too often, but you saw it somewhat in 2015, where a lot of people started to think the economy is getting too hot. So there's an attempt to slow it down a little bit. So we've got open market operations as one tool. Another tool would be the discount rate. Discount rate is banks can borrow from the Federal Reserve, and if you borrow from the Federal Reserve, you have to pay interest. That interest rate you pay the Federal Reserve when you borrow from it is called the discount rate. If you borrow from the Fed is going to create the cash that lends to you. What it means is that if it lowers the discount rate, then more banks would borrow from it, which would mean the money supply would go up. If they raise the discount rate, meaning they raise the interest rate, that must be paid when you borrow from the Fed. Then that would reduce the money supply because they're just basically not going to create anything more. And you see that what it could also do, the Federal Reserve, is it can try to affect the reserve deposit ratio. And it doesn't really do this that often. In fact, this isn't as relevant today as it was even 5 years ago when these slides were made. And this is because banks don't generally, they are basically under lending. For proof of that, sorry, this is also historical data. There we go. So really what's been incredibly interesting about the recession of 2008-2009 is that banks no longer hold the minimum amount of reserves. In fact, if anything, you see that banks are holding a lot of excess reserves because they don't know what the future is going to look like. Another somewhat of an explanation for why the interest rate is what it was that was offered to me, because basically Navy Federal is the US's largest credit union. It's holding on to a lot of cash, right? And you got to make it work for you at least a little bit. And you certainly see this here is that since the 2008-2009 crisis, banks have reacted by storing more cash than they need to. And what's interesting is you don't really see that. I mean, look at that. The only other time you see that is in the recession of 2001, the tech bubble bursting, and that was very short. for the most part, banks held very little excess reserves. They're basically operating at the minimum. So that's why it's curious, because most of your textbooks talk about banks as if they don't hold any excess reserves, when in fact, the reality is different. Banks hold lots of excess reserves. That's just the way they are now. Now, the Federal Reserve does pay interest on those excess reserves if they put them with the bank. Now, what that does is it creates money supply. Let's go back here. The interest rate on excess reserves, yeah, I mean, it's pretty low because they're trying to make banks lend out as much as possible, but banks aren't pretty much going to do anything. But what's interesting is that banks, depository banks, could make up almost close to 2.5% by storing their excess reserves at the Federal Reserve. Now it's crazy, right? They're not getting anything, which means that you're getting a little bit of a worrisome situation here, because that could mean that banks now, because they're not going to get very much on their excess reserves held at the Federal Reserve, the Federal Reserve wants banks to lend out money. You're trying to force the banks to lend out money. But, it could create a bad situation where they just say they make loans that they otherwise wouldn't. To Scheiding, to my house. Now, the problem with the problem with monetary policy is that you can't exactly control what's happening. You can't exactly control what's happening to the money supply over time. And so it becomes a little bit difficult to get the precise change that you need. And that's because households can change how much cash they hold. Right? We saw this kind of with the coin shortage where people were holding on to their coins, but people, I suspect, are also holding on to more cash. And so if they hold on to more cash, that reduces the multiplier. And we also, again, see this idea that banks, how they hold excess reserves is changing based on the fact that the interest rate paid. So it's not like the Fed can exactly control how the money supply changes, because there are some things like this that are outside of its hands. Okay, some of these remaining slides here just talk about specific case studies from the textbook. They're not really, I mean, I appreciate the past, don't get me wrong, I appreciate what happened in the past, but I want to focus a little bit more on what's happening here in the future. Let me spend our remaining time here just going over these 3 slides of the summary again, just to highlight the major points of what we did, and then I will end our discussion. So again, money is anything that meets these functions: store value, medium of exchange, store value, unit of account. Most of the money that we use is a fiat money, meaning it has no intrinsic value, has no use value. The only thing that gives it value is the government. But anything can be money as long as it fulfills these conditions. And so then the money supply, like when it's gold, when it's a commodity money, you don't need to talk about controlling the money supply. The money supply is how much gold you have. When you can print as much as you want, because it's a paper currency, you then have to have someone that manages how much money is printed. And that's going to be with the central bank in an economy, in our case, the Federal Reserve. And the Federal Reserve is going to manage that money supply along with the fractional reserve banking system. where the banks lend out a portion of their reserves. The Federal Reserve is going to control the money supply, how much money exists, with 4 tools: open market operations, meaning buying and selling existing debt; the reserve requirement, how much banks have to hold at a minimum; discount rate, the interest rate that they charge banks when they lend the money to it; and the interest on reserves, how much banks get from the Federal Reserve when they store money at that institution. Again, really the only thing I said that was important here is what's happened since 2008 and 2009 is that we have taken a great number of steps to control banks' lending practices and ensure that they don't overlend money. Okay. And this part here. Okay, I'm back to being here. That basically concludes my discussion, at least, of the monetary system. What we're going to do from there, the way that this sets itself up is from here, we're going to start to look at a greater deal of the monetary system, and again, how the money system and the banking system that we talked about now feeds into the larger economy. And more specifically, we're going to start to look at inflation, unemployment, and the GDP, the 3 major economic statistics. And we're going to look at how the monetary system can influence those 3 statistics. A little bit kind of what I talked about already with CPI and GDP, about how the money supply can change those things. We're going to look at those in a little bit more detail in the following weeks. So really the big thing here, I'm going to update the weekly tasks again. But I know last week I made the false promise that we'd be all done with the Bloomberg stuff, that it would be all ready to use. We had the minor hiccup. I just sent out the last email today. As long as the IT gets to the lab tomorrow, which I think they will, I'll send an email to the class when it's ready. But again, you should be able to, I should hopefully be able to see my screen here. If you can't say something, but you should be able to go to, let me log out here. You should be able to go to this website, portal.bloombergforeducation.com. Go on to that website, portal.bloombergforeducation.com. First time you're doing this, you would sign up for the account. You need to use your hawaii.edu email address because that's what I entered in as an acceptable address. You would then log in once you've created your account. And you're going to see fewer tabs on the top here, but you're going to have BMC and you're going to have terminals. Go to terminals then next, and you're going to start the process where you're going to request an account. This is mine. Yours is not going to look like mine because on mine, I'm activating people here so you can see some of the people in our class who I've activated already. You're going to go into this and you're going to do this. Once we get through this thing tomorrow on my end, there's going to be more shared terminals, which is then going to allow Steve and the others in this class to be able to sign up for, to actually start using the terminals and to start taking the Bloomberg Market Concepts. Don't think that I got a 78.9. My son was playing with my iPad and incorrectly answering things. So what it gave me the challenge, I had to get perfect scores on everything else for it to average out. So anyway, you're going to have a certain number of things here with the blue ribbons here that you're going to need to complete, but you can't do these until we get this thing figured out by the probably hopefully by tomorrow. And at that point, when it is, I'll send an email to the rest of the class. Okay. that ends it for my lecture today. I will, like I do always, I will log off last. So if you have any questions, I'm going to stop the recording now. But if you have any questions, just don't log out and just wait to ask them. Otherwise, I'm going to stop the recording at this point and then I will log out last.